Good morning. Before we begin, I want to invite you to subscribe to this channel if you haven't already. Our focus here is on disciplined, thoughtful financial analysis, free from hype, free from shortcuts, and grounded in reality. If you value that approach, please subscribe. It takes just one click, and it helps us continue creating content for serious investors. Subscribe for thoughtful, disciplined financial insights. Now, let's talk about what's happening in the markets right now. We are witnessing something significant. The jobs data released this week has shocked the market, and in response, precious metals have surged. Gold and silver are rallying hard. But before you celebrate or panic, we need to understand what's really happening here. This isn't just about a number, it's about what that number reveals about the economy, about investor psychology, and about how different asset classes respond when certainty crumbles. Over the next 25 minutes, we're going to walk through this carefully. We'll examine the data, we'll explore why precious metals are responding this way, and most importantly, we'll talk about what you should actually do with this information. This is not a prediction. This is not financial advice. This is an analysis of market forces and a conversation about how disciplined investors should think. Are you ready? Let's begin. The jobs data is released monthly. It tells us how many people found work, how many lost it, and what the unemployment rate looks like. Economists watch this number religiously because employment is one of the most reliable signals of economic health. When the jobs data is strong, it suggests the economy is expanding. People are being hired. Businesses are confident. Consumers have income and can spend. The Federal Reserve watches this closely because employment is part of their mandate. They're supposed to maximize employment while controlling inflation. But here's what's critical. This data is also one of the most important triggers for shifts in monetary policy. When employment weakens unexpectedly, it sends a message. That message reverberates through every asset class. This week's jobs report came in significantly weaker than expected. We're not talking about a minor miss. We're talking about a meaningful shortfall in job creation and a rise in the unemployment rate. Now, on the surface, this might seem like straightforward bad news for the economy. And in one sense, it is. But here's where it gets interesting from an investment perspective. Markets are forward-looking. The market doesn't care as much about what just happened as it cares about what happens next. When jobs weaken unexpectedly, investors immediately begin asking, what will the Federal Reserve do? The Federal Reserve has been raising interest rates to combat inflation. This is a well-documented cycle. The Fed tightened aggressively and rates went up. Higher rates make borrowing more expensive, which slows the economy and theoretically brings inflation down. But there's always a limit to how much tightening an economy can take. Push too hard and you trigger a downturn. Push too long and you risk unemployment rising and economic contraction accelerating. This jobs report suggests we may be reaching that limit. When the market sees weakening employment data, it starts to price in the possibility of a policy reversal. What does a policy reversal mean? It typically means rate cuts, lower rates, more money in the system, easier borrowing conditions. And here's what's crucial. When investors believe rates will be cut, they immediately start repositioning their portfolios. Gold and silver respond to rate expectations in a very specific way. Let me explain this clearly. When interest rates are high, bonds and savings accounts become attractive. You can lock in a decent return without taking much risk. This makes gold and silver less appealing because precious metals don't pay interest or dividends. They just sit there. But when interest rates fall, or when investors expect them to fall, the equation changes. Bonds become less attractive. Cash and savings accounts earns almost nothing. Suddenly, holding an asset that preserves value and has historically acted as insurance against currency debasement looks much smarter. Additionally, precious metals are priced in dollars. When the Fed cuts rates and signals looser monetary policy, it often weakens the dollar. A weaker dollar makes gold and silver cheaper for foreign investors and actually makes the metals more valuable when you have fewer dollars to spend. This is why we're seeing the rally right now. The market is pricing in the possibility that the Fed will cut rates soon, possibly aggressively, and precious metals are the natural beneficiary of that shift in expectations. To truly understand what's happening, we need to zoom out and look at where we are in the broader economic cycle. The Federal Reserve began raising rates in March 2022. This was a significant and rapid tightening cycle. Over the course of about 18 months, rates went from essentially 0 to over 5%. That's one of the fastest rate increases in modern history. The goal was to fight inflation, which had reached levels not seen in 4 decades. There was legitimate urgency to this, but the effects of monetary tightening work with a lag. The Fed raises rates today, but the full impact on the economy takes months or even years to materialize. This is why central banking is sometimes described as flying blind. You're making decisions based on information that's already outdated. We're now seeing the lag effects catch up. Tighter money and higher rates are making mortgages expensive, slowing the housing market. They're making car loans expensive. They're making business loans more costly. Consumers are feeling the squeeze. Businesses are feeling the squeeze. So now we have a situation where inflation is coming down, but the cost of getting that inflation down is starting to show up in the labor market. One thing that professional investors watch very closely is the yield curve, specifically the spread between long-term and short-term interest rates. When short-term rates are higher than long-term rates, that's called an inversion. It's historically been one of the most reliable recession indicators. An inverted yield curve has preceded virtually every recession in the modern era. We've had an inverted yield curve for over a year. That's a signal that the market has already priced in economic weakness ahead. Now, the presence of an inverted yield curve doesn't mean a recession is happening tomorrow, but it does mean the market is assigning significant probability to slowing economic activity in the coming months. This context matters because it explains why the jobs data hit differently. This wasn't a surprise in isolation. It was confirmation of what the market had already been suspecting, that the tightening cycle has done its job, and now the Fed needs to pivot. Here's something important about how markets work. They don't move smoothly. They move in waves driven by shifts in expectations and changes in sentiment. When everyone believes rates will keep going up, a certain class of assets performs well. Bonds suffer, banks do well because they earn more on their deposits, and investors stay away from gold. But when expectations shift, when the consensus moves from rates will stay high to rates will come down, the repricing happens fast, and it hits multiple asset classes simultaneously. This is what we're seeing right now. The jobs data didn't just trigger a rally in gold and silver. It also triggered a rally in bonds. Long-term government bonds have jumped in value as investors bet that the Fed will cut rates. It also triggered some weakness in bank stocks because banks benefit from higher rates and wider lending spreads. When rates come down, that advantage narrows. This is the essence of a regime shift. Different assets respond differently depending on what regime we're in. Right now, we're transitioning from a high rates regime to a rates coming down regime. And precious metals are benefiting from that transition. Let's look back. In 2008, we had a financial crisis. Banks failed. The economy contracted sharply. Unemployment spiked. What did the Fed do? They cut rates aggressively, ultimately bringing them to near zero. They also launched massive asset purchases, quantitative easing. They flooded the system with money. What happened to gold during that period? Gold rallied significantly. Why? Because investors were scared, and scared investors seek safety. Gold was perceived as a safe haven, but also because the Fed was increasing the money supply. More dollars in existence means each dollar is worth slightly less. Gold rose because of both the fear and the currency debasement story. Gold peaked at around $900 per ounce in 2011, 3 years after the crisis began. It wasn't an immediate spike. It was a multi-year rally driven by expectations of prolonged easy money. Fast forward to 2020, COVID hits, economic activity stops. The unemployment rate spikes to 14% almost overnight. It's the worst labor market data in modern history. The Fed responds with emergency rate cuts and massive quantitative easing. Trillions of dollars are pumped into the system. Gold rallies. By August 2020, gold hits a new all-time high at over $2,000 per ounce. Silver follows, eventually rallying to levels not seen since 2011. Again, the pattern is the same. Economic shock, policy response, precious metals rally. We're not in a 2008 level crisis right now. We're not in a 2020 level shock. The economy is still functioning. People are still employed. Unemployment is still relatively low historically. But we are seeing the early signs of slowing. We're seeing the lag effects of prior tightening, and we're seeing the market beginning to price in a policy shift. The question is, how aggressive will that shift be? Will the Fed cut rates once or twice just to stabilize? Or will we see more aggressive cuts? The answer matters for how much longer precious metals can rally. First, let's be clear. Gold and silver are related, but not identical assets. They move together more often than not, but they have different characteristics. Gold is viewed primarily as a store of value and a safe haven. It's money. Central banks hold it in their reserves. It's culturally valued in many parts of the world. It's relatively rare, and it's historically been used as currency. Silver is also precious, but it's more of an industrial metal. About half of silver demand comes from industrial uses: photography, electronics, solar panels, and other applications. The other half is investment demand in jewelry. This means silver is more sensitive to economic cycles. When the economy is strong, industrial demand for silver is strong, and silver rises. When the economy is weak, industrial demand falls, and silver can actually underperform gold. However, silver is also more volatile. When precious metals are rallying on risk-off sentiment or rate cuts, silver often outperforms gold because it moves faster and further. One key reason precious metals are rallying right now is the safe haven aspect. When investors get nervous, they want to hold something that will preserve value regardless of what happens in the financial system. This is different from holding bonds, which depend on faith in government creditworthiness. It's different from holding stocks, which depend on corporate profitability. Gold and silver are elemental. They can't go bankrupt. They have intrinsic value. But here's what's important. Safe haven demand only develops when investors actually get scared. You don't see massive flows into gold when everything is calm and everyone's confident in the system. You see those flows when confidence breaks. The jobs data breaking has triggered a confidence break. Not a massive panic. We're not there yet. But enough of a break that investors are hedging and repositioning. There's another reason precious metals are valued. They're supposed to act as inflation hedges. When currency debasement happens, when the government or the central bank prints money and dilutes the currency, gold and silver should theoretically hold their value while everything else prices up. This story has been central to precious metals investing for decades, and it's actually true over long time frames. Over 50 or 100 years, gold has held its purchasing power reasonably well, even as currencies have been debased. However, the inflation hedge story is more powerful when inflation is actually accelerating. Right now, inflation is coming down. The jobs report is even suggesting it might come down faster because of economic weakness. So the inflation hedge story is less relevant right now. The safe haven story and the rate cut story are more relevant. This matters because it tells us something about what could derail a precious metals rally. If the Fed starts signaling that they won't cut rates as much as the market expects, or if economic data stabilizes and the scare fades, precious metals could reverse. If you already own gold or silver, the first thing to understand is you don't need to do anything dramatic right now. You're experiencing what's called an unrealized gain. The value of your holding has increased. This is pleasant, but it's only a gain on paper until you actually sell. Many investors get emotionally attached to timing. They think, the rally has been good. Should I sell now and lock in the gains, or should I hold and ride it higher? This is the wrong framework for thinking about precious metals if you're holding them as a core position. If you hold precious metals, the proper way to think about them is as insurance. You don't own homeowners insurance, hoping your house burns down so you can profit. You own it for protection. Similarly, precious metals should be a small portion of your portfolio, generally 5 to 10%, held as protection against systemic risks. You own them because you believe there's value in having an asset that doesn't depend on the financial system functioning perfectly. You're not holding them to get rich. You're holding them to sleep at night. From this perspective, the current rally is actually gratifying, but it doesn't change the fundamental reason you own them. The insurance hasn't changed. Your system risk hasn't changed. The conditions that make precious metals valuable as insurance are still there. That said, if your precious metals allocation has grown to be a much larger portion of your portfolio than you originally intended, say it's now 15 or 20% instead of the 5 to 10% you planned, then trimming makes sense. Not because you're calling a top or predicting prices will fall, but because you're rebalancing back to a level that matches your risk tolerance and your understanding of what precious metals should represent in your portfolio. This is called letting winners run, but rebalancing. You're not trying to sell at the peak. You're just making sure one position doesn't dominate your portfolio so much that a reversal would harm you emotionally or financially. In some jurisdictions, precious metals held in physical form or certain investment vehicles have specific tax treatment. If you've held them for less than a year and sell at a gain, you might face short-term capital gains taxes, which are usually higher than long-term rates. This is a practical consideration worth discussing with a tax professional, but it shouldn't be the main driver of your decision. Holding a position just to avoid taxes is usually a mistake. Here's the real question to ask yourself. If precious metals fell 20% from here, would you still hold them? If the answer is yes, if you actually believe in them as insurance and you can tolerate volatility, then the current rally doesn't change anything. You hold through ups and downs. If the answer is no, if you're actually speculating on rate cuts and you'd panic if the thesis breaks, then you're not really suited to hold them in the first place. You're taking on volatility you can't actually stomach. Be honest with yourself about which investor you are. If you don't currently own precious metals and you're thinking about buying because of this rally, you need to slow down and think carefully. One of the most dangerous impulses in investing is FOMO, fear of missing out. You see an asset rally, you see headlines suggesting it could go higher, and you feel like you're missing something. Resist that impulse. It's not rational. Here's a brutal truth. Most people who try to catch a rally by buying after it's already started lose money. Why? Because rallies don't last forever, and you're buying closer to the peak than to the beginning. Remember when we talked about gold hitting new highs in 2020? A lot of people bought gold in August 2020 after it hit $2,000. Gold then fell back down to $1,700. Those people lost thousands. This doesn't mean gold is a bad investment. It means the worst time to buy anything is when everyone is excited about it. If you've decided that precious metals belong in your portfolio, and that's a valid decision, the smarter way to enter is through what's called dollar cost averaging. This means committing a certain amount of money per month or per quarter, regardless of price. Maybe it's $100 a month or $500 a month. You commit to that amount and you buy on that schedule. When prices are high, You buy less ounces. When prices are low, you buy more ounces. Over time, you end up with an average price that's better than if you tried to time the market. This takes the emotion out of it. You're not trying to call a bottom. You're not trying to call a top. You're just steadily building a position. Before you buy anything, decide how much of my portfolio should precious metals represent? 5%? 10%? Then calculate the dollar amount. If your portfolio is $100,000 and you want 10% in precious metals, that's $10,000. How should you get there? Dollar cost averaging over months or quarters makes more sense than trying to buy it all at once. There are many ways to own precious metals: physical coins or bars, mining stocks, ETFs that hold physical metals, futures contracts, options, etc. For most investors who are serious but not obsessive, a simple approach works best. For gold, buy through a reputable ETF or physical bars stored safely. For silver, same approach. Avoid mining stocks if you're new to investing. They add company-specific risk on top of metal price risk. Avoid complicated derivatives unless you really know what you're doing. The point is to get exposure to the metal itself, not to guess on mining company performance or to engage in leverage-based trading. This is perhaps the most common error. You buy precious metals, they rally 10%, and you feel smart. You want to sell and lock in the gain. Then they rally another 10%, and you regret selling. Or the reverse. You buy, the price falls 5%, you panic and sell at the bottom. Precious metals are volatile. This is a feature, not a bug. If you're holding them, you need to accept that volatility as the cost of having insurance. The antidote to this mistake is simple. Define your allocation before you invest. Then don't check prices daily. Check them quarterly or annually. Let the long-term thesis work. Some investors buy precious metals through futures contracts or with borrowed money, hoping to amplify returns. This is extremely dangerous. If you can only afford to own 5 ounces of gold, but you buy 50 ounces on margin, hoping prices will double, you're not investing. You're gambling. And when prices move against you, you get liquidated. Leverage turns an insurance position into a speculative bet. It also turns a manageable drawdown into a catastrophic one. If you can't afford to own precious metals without borrowing money, you're not ready. Save more first. You'll see headlines suggesting gold will hit $3,000 or $5,000. You'll see analysts making bold predictions. You'll see social media filled with people convinced they know where prices are heading. None of them actually know. Anyone who tells you they know where gold will be in 6 months is either lying or delusional. The only things you can know about precious metals are the fundamental reasons to own them: inflation risk, currency debasement risk, and systemic risk. The price at which they'll trade is unknowable. Make decisions based on fundamentals, not on price predictions. While your money is in precious metals, earning 0% and sitting flat, it could be in a bond earning 4% or 5%, or in a dividend stock earning yields. Over long periods, opportunity cost matters. If precious metals go flat for 5 years, while bonds are earning 5% annually, that's a meaningful difference. This doesn't mean don't own precious metals. It means think about the trade-off. The money you allocate to precious metals is money not available for other assets. Make sure that's okay with you. This is the big one. Precious metals are insurance. Insurance is a cost. You pay for it, hoping you never need it. But many people approach precious metals as an investment, expecting high returns. When precious metals flatline, they get frustrated and sell. Reframe your thinking. If your house doesn't burn down, is your homeowner's insurance a bad investment? No, it did its job. It protected you against catastrophe. Same with precious metals. If they sit flat for years and nothing goes wrong, they've done their job perfectly. The financial media thrives on urgency and fear. A single jobs report becomes the economic collapse. A precious metals rally becomes the biggest opportunity of the decade. These narratives are designed to keep you watching, not to help you invest wisely. Your job is to step back from the noise, think about fundamentals, and make rational decisions, not to react to every headline. We touched on this earlier, but it's worth emphasizing. The human brain is terrible at predicting market turning points, but we think we're good at it, so investors wait for prices to fall further before buying. Then prices rally, and they buy at the top out of FOMO. Then prices fall, and they get out. Dollar cost averaging removes this. It removes the need to be right about timing. It removes the emotional decisions. If you're serious about precious metals, commit to buying a fixed amount on a regular schedule. Do it. Don't overthink it. In a balanced portfolio, you own multiple asset classes: stocks, bonds, real estate, commodities, and cash. Each asset class responds differently to different economic scenarios. Precious metals have a special quality. They often rally when stocks fall. This is called negative correlation, and it's valuable for portfolio construction. Right now, we're seeing precious metals rally at the same time bonds are rallying, as investors bet on rate cuts. This is actually a good outcome for portfolio diversification. Your portfolio is moving in multiple directions, which reduces your overall risk. Rather than trying to predict the future, think about different scenarios and what they mean for your portfolio. Scenario 1, the Fed cuts rates aggressively, the economy slows, and we enter a mild recession. In this scenario, precious metals, bonds, and defensive stocks do well. Growth stocks and cyclicals struggle. Scenario 2, the jobs data was just a blip. The economy stabilizes. The Fed cuts rates minimally. In this scenario, everything is okay and you don't see much movement. Scenario 3, inflation accelerates again. The Fed is forced to stay tight or even tighten further. In this scenario, bonds sell off, precious metals might rally due to inflation concerns, but growth stocks might also struggle. Which scenario is most likely? Nobody truly knows. But a well-diversified portfolio handles all three reasonably well because you own assets that benefit in different scenarios. That's the real benefit of precious metals in a portfolio. Not that they're going to make you rich, but that they'll protect you in the scenario where stocks and bonds both struggle. A truly disciplined investor doesn't just build a portfolio, they maintain it. Once a year, you review your allocation. If your stocks have rallied and now represent 70% instead of 60%, you rebalance. You sell some stocks and buy bonds, precious metals, or cash to get back to your target. This forces you to sell high when stocks have rallied and buy low in the other asset classes. It's the opposite of what most investors do emotionally. Precious metals rallies might provide the perfect opportunity for rebalancing. If they've rallied 20% in a few weeks, and now your precious metals allocation is much larger than intended, trim it back. Use those proceeds to buy undervalued assets. This isn't selling at the peak. This is maintaining discipline. Before we wrap up, we need to address the elephant in the room: debt. The United States, like most developed economies, has run large budget deficits for years. The national debt has grown substantially. Unfunded liabilities in Social Security and Medicare are enormous. At some point, this has to be addressed. And historically, there are only a few ways to address massive government debt. Option 1, run surpluses and pay it down. This is politically difficult and economically unpopular. Option 2, default or restructure the debt. This is catastrophic. Option 3, inflate it away. Let inflation erode the real value of the debt. Which option is most likely? Based on history and political incentives, option 3 is most likely, which means you should expect a period of inflation ahead, even if it's not happening right now. This is actually a fundamental case for owning precious metals, not because of any current news, but because of the structural reality that the government will likely choose inflation as the path of least resistance. The dollar is the world's reserve currency. This gives the United States massive advantages, but it also means that when the Fed prints money, it affects the entire global economy. As more dollars flow into the system and the dollar weakens, precious metals, which are priced in dollars, become more attractive not just for Americans, but for investors worldwide. Additionally, geopolitical tensions are rising. When investors get worried about geopolitical risk, they also tend to move toward precious metals as a safe haven. These are longer-term forces that support precious metals, independent of short-term economic data. There's a theoretical concept called the natural rate of interest, the rate that would exist if inflation were stable and the economy were in equilibrium. Most economists think that natural rate is somewhere between 2 and 3% in real terms. Add in inflation expectations, and you get a nominal rate of 4 to 5%. The Fed has been holding rates above 5%, which is restrictive. The market is pricing in cuts because rates are probably too high relative to the natural rate. But if the Fed cuts too much, inflation could accelerate again. Then they'd have to tighten again. This could create a cycle. The point is, we're likely in a period of higher rates and higher volatility for the foreseeable future. That's another reason to own precious metals. They perform well in periods of inflation uncertainty. If you own precious metals, 1, review your allocation as a percentage of your total portfolio. 2, if it has grown significantly due to the rally, consider trimming back to your target allocation. 3, if it's still at your target, do nothing. Let the insurance position work. 4, don't check prices daily. Check quarterly at most. 5, continue to accumulate slowly if you're below your target allocation. 1, first, define your target allocation. 5%? 10%? Something else? Be specific. 2, calculate the dollar amount needed to reach that allocation. 3, instead of buying it all now, commit to buying a fixed amount monthly or quarterly. 4, use the current rally as a reminder of why you want them, not as a FOMO signal to buy aggressively. 5, decide on the form you want, physical, ETF, etc., and execute your plan. The most important thing is a mindset shift. Stop thinking about precious metals as a quick profit opportunity. Start thinking about them as insurance. Insurance is boring. It sits there. It doesn't generate returns, but it protects you against catastrophe. If you can embrace that mindset, you can actually hold precious metals through volatility without panic selling. And that's where the real benefit comes. True, gold doesn't pay a dividend, silver doesn't pay interest. They sit there and you own them. But this is actually a feature during certain periods. When interest rates are low or negative in real terms, meaning inflation is eating into any returns bonds provide, precious metals' lack of income becomes irrelevant. You own them for preservation, not for yield. Additionally, the opportunity cost of owning precious metals varies with conditions. When bonds are yielding 1% and inflation is 3%, you're losing money in real terms holding bonds. Precious metals look smart. When bonds are yielding 5% and inflation is 2%, bonds are attractive. You might hold less precious metals. The point is, the cost benefit of precious metals changes with economic conditions. But there's always a scenario where they make sense. I'm not. I'm trying to explain the forces at work. The jobs data weakening is real. The likelihood of rate cuts is real. The historical relationship between precious metals and these events is real. But none of this means you have to buy precious metals. It means you should understand the case for them and decide if it fits your circumstances. Some people genuinely don't need precious metals. If you have a secure job, a paid-off home, and stable income, your personal financial security is high. You might not need insurance through precious metals. Others face more uncertainty. Their income is variable, or they're worried about system-level risks. For them, precious metals make more sense. This question itself reveals the speculatory mindset that gets most people in trouble. If you're buying precious metals as insurance, you don't care about missing rallies. You only care about being protected when you need it. And here's the thing. Precious metals rally are often followed by reversals. The 2008 gold rally didn't just go up forever. There were significant pullbacks. Same with 2020. If you miss a rally but buy during a pullback, you're actually in a better position. You've paid a lower price for the same insurance. Stop thinking about missing rallies. Start thinking about having what you need when you need it. Human beings are driven by fear and greed. We're wired to panic when we're scared and to get excited when we're winning. These emotions are useful for survival in the wild. They're terrible for investing. When the jobs data broke, fear spiked. That drove investors to safe havens, including precious metals. This is a fear-based rally. Fear-based rallies don't last forever. Eventually, clarity returns or conditions change and the fear fades. When it does, the rally fades with it. Investors who buy during a fear-based rally out of panic are often the same ones who sell when fear fades, locking in losses. The solution is discipline. Define your plan. Execute your plan. Don't change your plan based on how you feel. Successful long-term investors have conviction. They believe in something, and they stick with it through volatility. This conviction doesn't come from being right all the time. It comes from having a logical framework that makes sense to them. For precious metals, the conviction should be, I believe owning some hard assets that don't depend on the financial system functioning normally is wise insurance. I'm not trying to get rich, I'm trying to sleep at night. With that conviction, a 20% rally doesn't excite you into selling. A 20% decline doesn't scare you into panic selling. You own them through cycles. The jobs data is important. The precious metals rally is interesting, but in the context of a 30-year investing time frame, this week's data point is a grain of sand on a beach. Successful investors zoom out. They ask themselves, where am I trying to be in 10, 20, 30 years? What asset allocation will help me get there? What actions should I take this week or month to move closer to that goal?